So we're now on the module 4 for fundamentals of accounting. We're still on the accounting cycle, but this time this is analyzing business transactions and account titles. So we've already discussed what a source document is. Now we are going to understand what are the transactions indicated in the source document. So these are the common transactions found in the source documents: investment, cash sale, accounts receivable, account sale, purchase of supplies, purchase of merchandise, received bills, paid rent, paid expenses, and acquire loans. What are transactions? Accounting transactions are events or occurrences which bring changes in assets, liabilities, and owner's equity of the business. These are business events having monetary impact on the financial statements of a business. They are recorded in the accounting books of the business. Examples of accounting transactions: sale in cash to a customer, sale on credit to a customer, received cash in payment of an invoice owed by a customer, purchase fixed assets from a supplier, record the depreciation of a fixed asset over time, purchase consumable supplies from a supplier, investment in another business, investment in marketable securities, engaging in a hedge to mitigate the effects of an unfavorable price change, borrow funds from a lender, issue dividends to investors, sale of assets to a third party. These transactions may be internal and external. What are internal transactions? Internal transactions are those transactions without source documents. Internal transactions are those which have monetary impact but which no outside person or organization is involved. It does not relate with two parties, nor does it involve another second party. That is why there is no need for a source document. So these are the examples of internal transactions: use of supplies, expired prepayments, depreciation expense, bad debts on accounts receivable, setting up of petty cash fund, accrual of expenses, and income. As we have said, external transactions are transactions that occur between two persons or two organizations, or between a person and organization in terms of money, which are covered by a source document. So if there is no source document, then that is internal transaction. If it has source document, then that is an external transaction. And external transactions are recorded on the first stage of the accounting cycle. Remember, we record external transactions first, then we record the internal transactions. So, in analyzing the source document, you have to find out what is the transaction. Then, if you have found out the transaction, you will analyze whether that transaction has affected asset, liabilities, and capital. So if you have determined that it has affected assets, liabilities, or capital, then you will proceed as to what account titles you are going to use to record that transaction. So you cannot say debit asset and credit liabilities, debit asset credit capital. No. What particular asset has been affected by the transaction? What particular liability has been affected by the transaction? And the same with capital. So you have to know the different account titles for assets, the different account titles for liability and capital. So these are the usual account titles for asset, liabilities, and capital. So you have cash, accounts receivable, allowance for bad debts, supplies, prepayments, equipment, building, accumulated depreciation, and land. For every depreciable asset, there is a corresponding accumulated depreciation. Land is the only asset that is not subject to depreciation. So for liabilities, we have accounts payable, notes payable, mortgage payable, and unearned revenue. For the capital account, we have the capital, drawing, revenue, supplies expense, rent expense, utilities expense, bad debts, and depreciation. What do you mean by account titles? Account titles are names or titles used to sort, record, and store transactions. So these are the account titles, and these are the description or definition for that account title. So when we talk about cash, it includes checking account balance, that is cash in bank. And then we have cash on hand, and that includes currency, coins, checks received from customers but not yet deposited. Next item will be account receivable. Accounts receivable are amounts owed to the company for services performed or products sold but not yet paid for. So if you have sold goods or performed services but you did not receive any payment for that service, then instead of recording it as a cash transaction, you record it as an account transaction. That's why you have accounts receivable. Take note of the color of the font. When it's black, these account titles are applicable to all forms of business organization. Meaning to say, service, merchandising, or manufacturing. These forms of business organization use the same account title or same account titles. So you will note that the color changed here because this this blue font will pertain only to manufacturing business. So the black one, this pertains to service, merchandising, and manufacturing. The blue ones will only be available for manufacturing. The red ones are available only for merchandising. Now we go to supplies. Supplies, we're not going to discuss work in process inventory and finished goods inventory as they pertain to manufacturing concern. So we will just be tackling discussion on services and merchandising. So we have supplies. Cost of supplies that have not been used. Supplies that have been used are recorded in supplies expense. So there are two methods in recording supplies. You can record it as an outright expense or as an asset. So if you're going to use supplies as an asset, then you record it as a supplies. If you want to record it as an expense, then you record it as a supplies expense. I will explain those methods of recording assets in the later part of our discussion. So prepaid insurance, cost of insurance that is paid in advance, and it includes a future accounting period. So if you pay an insurance of 24,000 for a 2-year contract, then you have prepaid it because you included not only the current period but also the future period. So equipment, cost to acquire and prepare equipment for the use of company. And then it has its corresponding accumulated depreciation. Accumulated depreciation is the amount of equipment cost that has been allocated to depreciation expense since the time the equipment was acquired. When you buy an equipment, every year you recognize depreciation expense. The depreciation expense forms part of the current or the period cost. However, that expense has to be recorded also as a deduction of equipment. So there is an account called accumulated depreciation to record the depreciation expense of the asset over the years. So buildings, we have buildings, cost to purchase or construct buildings for use by the company or business. Then it has a corresponding accumulated depreciation. Land is the only asset that cannot be depreciated. On the contrary, it appreciates its value. So there is no accumulated depreciation for land. Land includes cost to acquire and prepare the land for use by the business or company. So we go to the liabilities. We have notes payable, accounts payable, wages payable, interest payable, and other expenses payable. So notes payable, the amount of principal due on a formal written promise to pay. Loans from banks are included in this account. Accounts payable, amount owed to suppliers who provided goods and services to the company but did not require immediate payment in cash. Wage payable, amount owed to employees for hours worked but not yet paid. Interest payable, amount owed for interest on notes payable up until the date of the balance sheet. This is computed by multiplying the amount of the note times the effective rate times the time period. So you will learn the computation of that interest payable later. So we have mortgage loan payable, a formal loan that involves a lien on a real property, real estate until the loan is repaid. So if there is no mortgage or chattel involved, or there is no lien, then there is that is considered notes payable only if it is that in a formal loan document. But if it has a mortgage to support the loan, then that loan will be called mortgage loan payable. Unearned revenues are amounts received in advance for delivering goods or providing services. If you have received amount in advance without yet performing the services or delivering the goods, then that becomes a liability. And the account title being used for that is unearned revenues. When the goods are delivered or services are provided, this liability amount decreases. Service revenue. Amount earned from providing services to clients, either for cash or on credit. When a service is provided on credit, both this account and account receivable will increase. So, in a service business, the revenue account is service revenue. In a merchandising business and manufacturing business, the revenue account is sales. So, sales, it contains the record of all sales transactions. This This includes both cash and credit sales. The account total is then paired with the sales returns and allowances account to derive the net sales figure that is listed in the income statement. So the sales account has a contra account which is called sales returns and allowances. So this is the sales and returns allowances. A contra revenue account that reports merchandise returned by a customer and allowances granted to a customer because the seller shipped improper or defective merchandise. Sales returns occur when customers return defective, damaged, or otherwise undesirable products to the seller. Sales allowances occur when customers agree to keep such merchandise in return for a reduction in the selling price. This reduces the seller's accounts receivable and is subtracted from sales along with sales discount to arrive at net sales. So there are two items to be found in the sales returns and allowances. First, the merchandise returned by a customer, that is sales returns. Then, the other one is the allowances granted to a customer. The goods are defective, but these are not returned, but the buyer was given certain amount of allowance or discount for the defect of the goods not returned. Sales discount. A sales discount is a reduction in the price of a product or service that is offered by the seller in exchange for early payment by the buyer. So, this sales discount is a cash discount for the early payment. There has already been a sales transaction, but instead of paying on a due date, the buyer pays before due date, then the seller gives that buyer a certain amount of discount. That is a cash discount. When from the point of view of the seller, that is called sales discount. From the point of view of the buyer, that is called purchase discount. So, sales discounts and purchase discounts are both cash discounts. The term changes depending on the point of depending on who is recording the transaction. If it is the seller who's recording the transaction, it is called sales discounts. If it is the buyer who's recording the transaction, it is called purchase discounts. So we have different kinds of salaries depending upon the nature of the business. So if it is a service business, very limited amount kinds of expenses only. So we have salaries expense, wages expense, rent expense, utilities expense. So what's the difference between salaries expense and wage expense? Expenses incurred for the work performed by salaried employees during the accounting period. These employees normally receive a fixed amount on a weekly, monthly, or annual basis. So if it is based on a fixed amount and received on a regular basis, then that is salary. Now, expenses incurred for the work performed by non-salaried employees during the accounting period. These employees receive an hourly rate of pay. So if the payment is based on hour or piece of work and it is not on a regular basis, then you call that wages expense. Rent expense is the cost of occupying the space or premise. Telephone expense, cost of telephone use during the current accounting period. Advertising expense, costs incurred by the company during the accounting period for advertisements, promotions, and other selling expenses. Depreciation expense, cost of long-term assets allocated to expense during the current accounting period. So, as we have discussed, when you buy a depreciable asset, you allocate a certain amount of depreciation expense for the period. And that depreciation expense is recorded in the accumulated depreciation to be deducted from the value of the asset. It depreciates, okay? Expense accounts for merchandising and manufacturing businesses. So, in the service business, there is no account title purchases. The account title purchases is applicable only for merchandising and manufacturing business. So, purchases is a temporary account used in the periodic inventory system to record the purchases of merchandise for resale. But purchases of equipment or supplies are not recorded in the purchases account. What are being recorded in purchases account are just purchases of merchandise for resale in merchandising or materials in manufacturing concern. This account reports the gross amount of purchases of merchandise. Net purchases is the amount of purchases minus purchases returns, purchases allowances, and purchases discount. So purchase returns is the opposite, or not opposite actually, but the same with sales returns and allowances. It's just the one recording this time is not the seller but the buyer. Cost of goods sold is also applicable only for merchandising and manufacturing business. Cost of goods sold, it refers to the direct cost attributable to the procurement or production of the goods sold by the business. The cost of goods sold is the cost of the products that a retailer, distributor, or manufacturer has sold. This account is used in perpetual inventory system of accounting. So you take note, the other one, the purchase the purchases account is said to be for the periodic. The cost of goods sold account is for the perpetual inventory system. What is periodic and what is perpetual? When you talk about periodic system, the company or the business conducts annual inventory or annual counting of the goods. still available for sale at the end of the accounting period. When you talk about perpetual, you do not count the inventory at the end of the period because there is already a ledger card showing how much has been left of the goods purchased. So we'll discuss that more in details in the succeeding discussions. So purchase returns and allowances, purchase discounts, that these are similar with sales returns and allowances and purchase discount. But this time, it is the buyer who's going to record these accounts or amounts. This one, freight in. Freight in is the shipping cost to be paid by the buyer of merchandise purchased when the terms are FOB shipping point. Freight in is considered to be part of the cost of the merchandise and should be included in inventory if the merchandise has been sold. A freight in is a transportation expense on the part of the buyer. But instead of considering it as an outright expense, freight in is added to the cost of the merchandise purchased. So when the merchandise is sold, the cost of freight in is included in the computation of the cost of that merchandise. So there are other items which are non-operating revenue and expense accounts. So interest revenues, gain on sale of assets, loss on sale of assets. So these are non-operating accounts. This is not the primary business of the this is not the primary service or merchandise of the business. But if the business is a bank, interest revenue is an operating revenue, or a loan giver or a loan uh, not a loan shark, a loan a lending institution, then interest revenue is is an operating revenue. But if it is not, then interest revenue is a non-operating revenue. So, interest and dividends earned on bank accounts, investments, or notes receivable. This account is increased when the interest is earned and either cash or interest receivable is also increased. Gain on sale of assets. So, it becomes non-operating. It is a non-operating transaction if the business is um, merchandising but not of this kind of asset or service. Gain on sale of assets occurs when the company sells one of its assets other than inventory for more than the asset's book value. So, loss on sale of asset is the opposite of gain on sale of asset. When the company sells one of its assets other than inventory, meaning to say not an inventory, for less than the asset's book value. So, for capital account, it depends on the form of business organization. For sole proprietorship, we have the capital and drawing as part of the capital accounts. So, for example, Tarima Core is the owner of the business, then Tarima Core Capital will be the account title to be used for investment in the business. Now, Tarima Core Drawing will be used as an account for the withdrawal of cash from the business by the owner. Capital for partnership. For each partner, there will be capital account and drawing account. So, for instance, this is a partnership between Tarima Core and Macoral. So you will set up an account for Tarima Core Capital and Macoral Capital along with its Tarima Core drawing and Macoral drawing. So drawing is the withdrawal of cash from or other assets from the business for personal use. So the capital, on the other hand, is the investment of assets to the business. So the capital accounts used for corporation will be capital stock because the corporation raises capital from issuance of stock. So there are two kinds of capital stock, common and preferred share. Pero now it is being called ordinary for the common and preferred is called preference share. So capital stock is the number of ordinary and preference shares that a company is authorized to issue according to its corporate charter or articles of incorporation. The amounts received by the corporation when it issued shares of its capital stock is reported in the shareholders' equity section of the balance sheet. So kapag if it's if it's if it's sole proprietorship, then only the name of the owner and the drawing account will be used, and it is called capital account. But when it is a corporation, you call that capital account as shareholders equity. So another capital account used in corporation is treasury stock. Treasury stock is the number of shares a company holds in its treasury. Treasury stock is essentially capital stock that has been bought back or was never issued to the public. Additional paid-in capital is the value of share capital above its stated par value and is an accounting item under shareholders' equity on the balance sheet. Additional paid-in capital can be created whenever a company issues new shares and can be reduced when a company repurchases its shares. So, when the company issues shares of stock over the par value, then it acquires additional paid-in capital. So dividends. Dividends is similar with withdrawal or drawings in sole proprietorship and partnership because it is the distribution of income of the corporation to the owners or stockholders. So dividends are decided and managed by the company's board of directors, though they must be approved by the shareholders through their voting rights. So when it is a sole proprietorship, it's easier to get money from the business. You will just have to withdraw. But when you are a stockholder, a part owner of the business, you cannot just get money out of the business or corporation because the decision to give dividend is not rest solely on the stockholders but on the board of directors because the board of directors will decide whether there will be dividends or none in the during the period. So we have another account title for corporations, capital account. We have the retained earnings. Retained earnings are the profits that a company has earned to date, less any dividends or other distributions paid to investors. This amount is adjusted whenever there is an entry to the accounting records that impacts a revenue or expense account. Counterpart of the income summary account when there are prior years adjustments. So, when it's a sole proprietorship and partnership, you summarize the operations, the result of operations in an income summary account. In a corporation, you don't use the income summary account anymore. All transactions affecting adjustments to capital and income are being recorded in the retained earnings account. So, wala nang income summary account kapag corporation. Retained earnings account na ang ginagamit. So, let me give you the different account titles commonly used in business based on the form of business organization. So, sa assets of a service, merchandising, and manufacturing. Here is the list for service: cash, accounts receivable, supplies, prepaid asset, land, equipment, building. In merchandising, it's just the same: cash, accounts receivable, supplies, prepaid asset, land, equipment, building. But there is what you call merchandise inventory. So that's the distinction between service and merchandising. Now we go to manufacturing. You still have cash, accounts receivable, supplies, prepaid assets, land, equipment, building. But this time you have raw materials inventory, work in process inventory, and finished goods inventory. The finished goods inventory is equivalent to merchandise inventory, considering that it is in saleable form. But you call it finished goods because it is manufactured. So the finished product is not bought from another source, but manufactured or built or created by the business. So these are the distinctions in assets. So with regards to accounts payable or liability, service, merchandising, manufacturing, they are all the same. There's no distinction whatsoever. What is liability for the service will be the liability for merchandising and manufacturing. We go to the service for the capital. So there's a different form of there's no change in form of organization but only in business activities. So the capital account remain the same. If it's sole proprietorship, even if it's service, merchandising, or manufacturing, it uses the same capital accounts, capital and drawing. If it's a corporation, then you use the same accounts for corporation. You have the retained earnings, stocks, capital stock, paid in capital stock. With regards to revenue, then there will be distinction because of the varied activities. So, service revenue, the account titles being used for service business are service revenue, professional fees, commissions earned, fees earned, rental income, interest income. It depends on the kind of business. So, if it is the practice of profession, then you call it professional fees or service fees. But if it's on sale, and then you only receive commission for extending sales or generating sales, then you have commissions earned, fees earned. Now, when you're leasing a property, then you have the rental income. Or you are a lending institution, then you have interest income. For merchandising and manufacturing, we have the same revenue account: sales, sales returns, and allowances, and sales discount. So, for expenses, they are all the same. So, there are no distinction whatsoever when it comes to expenses except this one: purchases. You don't use the account purchases in service. You just use supplies expense. But when you are in merchandising, you have the account purchases. The same way with manufacturing. It has purchases account. So when it comes to expense, service has no purchases account, but merchandising and manufacturing have purchases account. Okay, so that's the distinction of the different business activities. So merchandising, other expenses will be freight in, freight out. Same with manufacturing, freight in, freight out. Merchandise inventory and cost of goods sold. So merchandise inventory and cost of goods sold, manufacturing also has that. But along with merchandise inventory and cost of goods sold, there are items under manufacturing business which are not found in the merchandising, and these are factory overhead, direct labor, direct materials, and indirect materials, which are costs used in the manufacture of goods. So merchandise, simplest is the service. More simple, more simplest is the service. More complicated is merchandising, and most complicated is manufacturing business.